Want to have a reason to do a prenup after you get your 10th real estate property? You'll definitely need one. Hey guys, in this video we're gonna talk about how to use your home equity to get money to buy your next investment property, namely home equity loans. Home equity loans and home equity lines of credit, also known as a HELOC, are loans that are secured by borrower's home. A borrower can take out an equity loan or credit line if they have equity in their home. If you want more info about what HELOC is, you can watch my video right here after you're done with this one, and as usual, I will leave a link down below into the description. What is equity? That is the difference between what you owe on the mortgage loan and the home's current market value. In other words, if a borrower has paid down their mortgage loan to the point where the value of the home exceeds the outstanding loan balance, the borrower can borrow a percentage of that difference, or equity. Home equity loans give the borrower a lump sum upfront for which to spend, and in return, they must make fixed payments over the life of the loan. Home equity loans also have a fixed interest rate. Conversely, HELOCs, or home equity lines of credit, are credit lines that allow a borrower to tap into as needed up to a certain preset credit limit. HELOCs have a variable interest rate and the payments are not usually fixed. Both home equity loans and home equity lines of credit allow consumers to gain access to funds that can be used for various purposes, including consolidation debt and making home improvements and more. However, there are distinct differences between home equity loans and equity lines of credit. What's a home equity loan? That is a fixed term loan granted by a lender to a borrower based on the equity in their home. Home equity loans are often referred to as a second mortgage. Borrowers apply for a set amount that they need, and if approved, receive that amount in a lump sum upfront. The home equity loan has a fixed interest rate, as I already said, and schedule of fixed payments for the term of the loan. Loan collateral and terms. The equity in your home is used as collateral, which is why it's called a second mortgage, and works similarly to conventional fixed rate mortgage. However, there needs to be enough equity into the home, meaning the first mortgage needs to be paid down by enough to be qualified to borrower via a home equity loan. The loan amount is based on several factors, including the combined loan to value ratio, or CLTV. Typically, the loan amount can be 80 to 90% of the property's appraised value. Other factors that go into the lender's credit decision include whether you have a good credit history, meaning you haven't been past due on your payments for other credit products, including the first mortgage loan. Lenders may check your credit score, which is numerical representation of your credit worthiness. I have more explanation videos I'll link up here and the link in the description down below. Payments and interest rate. Before we continue, I just want to remind you, if you want to be financially independent, smash that like button and consider subscribing so you can follow along my journey and retire early. So a home equity loan's interest rate is fixed, meaning the rate doesn't change over the years. Also, the payments are fixed equal amounts over the life of the loan. A portion of each payment goes to interest and the principal amount of the loan. Typically, the term of an equity loan can be anywhere from 5 to 30 years, but the length of the term must be approved by the lender. Whatever the period, borrowers will have stable, predictable monthly payments for the life of the equity loan. Advantages and disadvantages of the home equity loan. So that loan can be a good way to convert the equity you've built up in your home into cash, especially if you invest that cash in home renovations that increase the value of your home. Or you can always buy a second, third, fourth, fifth investment rental property. Usually the interest rates for home equity loans are lower than other credit products, such as personal credit loans and credit cards. Another benefit to home equity loans is that you can pay off the loan early and refinance the loan at a lower rate. A refinancing is merely taking out a new loan, presumably at a lower rate than the existing loan, because otherwise it wouldn't make sense to do it, and using the funds to pay off the higher rate loan. By refinancing at a lower rate, you can save on monthly payments and pay off the loan sooner. However, you would need to go through the credit approval process again, and there may be fees for booking the new loan. A disadvantage of that loan is that the home could be sold to satisfy the remaining debt if the loan is not paid off or goes into default or non-payment. As a result, you must be sure not to get overextended and pay more than you can afford to pay back. If the loan goes into a default, the bank may foreclose or take back the home to satisfy the debt. Also, if the real estate values decrease, the market value of your house could decline and you could end up owing more than your home is worth. Should you want to relocate and the home decreases in value, you might end up losing money on the sale of the home or be unable to move. And as usual, remember that the goal is not to look rich, but to be rich. So this is home equity loan in a nutshell. Thank you very much for watching, guys. Smash that like button, consider subscribing, and keep hustling.